Welcome to episode 15 of the YMB and BTC podcast. This week, for the first time ever, we're shutting up. That's right, the YMB team is taking the day off, and instead, we'll listen to an economics professor give his take on Bitcoin. Dr. Jeffrey Herbener is the chair of the Department of Economics at Grove City College. Today, he'll help us understand Bitcoin from a financial perspective. We'll explore the properties of Bitcoin and try to determine whether or not it could be used regularly as money. He'll also chat about the IRS's decision to tax Bitcoin as property and explain the monopolistic intentions behind that decision. Stay tuned for that and much more. Before we kick things off, I'd like to encourage you to visit our website, YMBandBTC.com, to find tipping addresses and social media links. I'm your host, Daniel Brown, but today we're listening to Dr. Jeffrey Herbener. Here we go.
So I guess we're going to get started now. It's really good to have Dr. Herbener here tonight to talk to us about Bitcoin, chair of our econ department, and just fantastic economist all around, Dr. Jeffrey Herbener.
Wow. Okay. Like Brian said, I'm an economist. So it's going to be an economic treatment subject to Bitcoin. So, technical matters are outside my area of expertise. But Bitcoin's made a big splash. They call it a cryptocurrency, and at least initially, a lot of debate about whether Bitcoin was money or could become money, or what exactly is this new stuff? What are the benefits, if any, of Bitcoin? Socially speaking, right outside the narrow crypto community here where this started. So we're going to deal with those sorts of topics, just these economic analysis of Bitcoin. So these are the things that I want to talk about with respect to money, and we'll proceed as we go down through this. There's one technical feature of money that a lot of people don't realize until they begin to ask questions about things like Bitcoin or about gold or some other claimed medium of exchange, and that is that money is always the general medium of exchange. That is to say, it's the most widely traded good in the entire market. And so, given that definition, of course, Bitcoin is obviously not money. Not money in that sort of strict technical sense. Right? Now, that doesn't mean it isn't something. It doesn't mean it couldn't be have some value as a medium of exchange or something of the sort. But it is certainly not money proper. Another aspect of this is, and we all know this as soon as I say it, you recognize this right away, that sometimes economists say money is the unit of account in society. In other words, we use it for accounting. All business people keep their books in accounts in their currency, in their money, in dollars. And I think it's safe to say that nobody keeps their accounts in Bitcoin. Right? It's another sort of obvious fact about Bitcoin is not money proper in society. Now again, does that mean it can't become money? Well, no, that's a different question. But currently, it's not the money that we use. It might be an auxiliary medium of exchange or something like this, but it's clearly not money. And the third thing that, and I want to talk about a little bit more about each of these, but the third thing is Bitcoin is sometimes claimed to be, or it can become, a kind of privately produced money. And this is why it's attracted to the libertarian community. It's a money outside the scope of the state. Okay? So that might be a good thing, not to have Janet Yellen controlling the entire money supply of the economy, generating credit expansions and so on. But there's certain conditions for the efficient production of anything on the market. Anything that is actually privately produced by entrepreneurs and private enterprise on the market, it follows certain profit and loss rules. And this opens up the question of whether Bitcoin production follows these rules or not. So we want to examine that feature of Bitcoin as well. So let's start with this general medium of exchange. I gathered up these data just to give you an idea of the extent of the size of the Bitcoin market. How big is it? Okay, well, this is market capitalization. Market capitalization is just the dollar value of all the stuff. The dollar value of all the Bitcoins. Whatever, 12 million and change Bitcoins. And then you value them at the current price, $450 or so. And you get this figure, $5.7 billion. If you add up the total market value of all the Bitcoins that exist in the world today, the total value is $5.7 billion. The transactions of Bitcoins, they've been averaging around 62, these are unique transactions of Bitcoin, 62,716 daily. So that's the volume of trade, as we would say. Now, if you apply these same measures to the New York Stock Exchange, the market capitalization of all the stock traded on the New York Stock Exchange, this is roughly 3,000 companies, is just shy of $17 trillion. And the volume of trade, the daily transactions on the New York Stock Exchange are over 5 billion. So this gives you a sense of the size of the Bitcoin market relative to just one financial market in the U.S., the New York Stock Exchange. One of the bigger companies in the country is Apple Inc. Apple Inc. has a market capitalization value of $479.3 billion. That means that the entire value of all the Bitcoins in the world make up about 1% of the value of Apple. This is not a big market. Pretty shrinking. I tried to find a company that's the same size as Bitcoin. Logitech. Make computer peripherals, right? I've got a wireless mouse, Logitech. I got my clickers, Logitech. That company is worth $5.7 billion. That company is worth exactly what all the Bitcoins added up that exist in the world today are worth. Again, I'm just trying to impress upon you. It's not a very big market, Bitcoin. They're certainly not the general medium of exchange, right? If you add up the dollar value of all the things that the dollar trades against, the market cap of everything that exists in the economy is something like $70 trillion. Bitcoin is 5.7B with a billion. So this is a very small market relative to actual currency markets. Okay, so this is what the recent price and volume of trading Bitcoins, volume on the left scale, and the price per Bitcoin on the right scale. And you can see quite a bit of volatility in the volume. The bars are the volume, and the price is given by the line. And these are price spreads during the day, right? The size of the price difference of trading during the day. You can see volatility during the day. Now, the interesting thing about this chart, this starts February 1st this year. So it's 2 months. February 1st runs to the 30th, yesterday, of March. So in 2 months, Bitcoins have gone from about $828 to $450. So Bitcoins have lost 46% of their value in 2 months. Now, the USD is pretty volatile with respect to other currencies in the world, the United States dollar. But it doesn't lose 46% of its value in 2 months. If it did, it wouldn't be a very good money. That's not a very desirable property for real money. You don't want this sort of churning, this price volatility. If you look at the entire history of the Bitcoin, this is a little bit harder to see, right? So it starts out and it's negligible. It's going a little bit in January last year. And then you can see the price volatility. Again, the bars are volume of trade, and the line, the kind of dotted line, is the price structure. So the big price run-up was just last Christmas, right, from November last year to about mid-December. The price went from something like, well, you can see it on the graph. It's something, this is like 150, 170-ish. This is 1,200. So in 2 months, it goes up like 7 times. And then it falls way back to right at the beginning of this year. It falls back. It loses about half its value from just a month before. Now, again, you can't have this kind of volatility with a real currency. Because people have choice in currencies, and they won't put up with this. They'll choose something that has a more predictable value in its movements. And as I pointed out, this move is about 46%. It's not quite, but this downward move in just the last couple of months. So that too would be a strike against Bitcoin being considered money. Here I put up a couple problems with price volatility, using the money with price volatility. And this is the way we say it in economics. When a business person is doing accounting and they're trying to determine how do I minimize my costs, and how do I choose goods to produce where I can get revenue greater than the cost. The money in which they're calculating these costs and revenues has to be, predictably variable. It can vary, but it can't change wildly. You can see the problem, right? Because you're buying up inputs today, let's say over the next few months, and then you're going to sell your output in 6 months or something. Well, if the money loses 50% of its purchasing power, you're sort of in big trouble, right? Your pricing structures are all messed up. It's really hard to do economic planning for the entrepreneur. And given that entrepreneurs have choices in currency, again, the idea of having a cryptocurrency is that we could choose this over the USD. We have a choice between the two, or between this and gold, or between some other currency. We'll choose one that's more stable. Businessmen will do this, and you won't get again a widespread use of Bitcoin. And this is a point I made before, that money provides the common unit for doing all this economic calculation. All the businessman's decisions in terms of production are done with an eye toward the effect on revenues and costs. So he's doing his net income statement, he's doing his accounts, his balance sheet. It's all in money. And that's when we know what is money. Money in society is what businessmen use to do their accounts. It's the unit of account. And again, Bitcoin has a long way to go before it becomes a unit of account for anybody, right? It's not used that way, as far as I know, by anybody. Some people use it as a medium of exchange, granted, but not as to do their accounts. Okay, now let's look at this production. This is another problem I identified, this question of efficient production. So these are the actual numbers of Bitcoin as a total stock. I just took this at the beginning of each year from 2010 on. And these are the percent increases. So you can see it was, more tech-savvy guys know that the logarithm can be solved more easily at the beginning, and so you get more production, right? It gets tougher and tougher, the problems get harder. So the Bitcoin production slows down, and then the maximum that can be mined is 21 million. So once you hit 21 million, there's nothing left to do on the production side. In other words, at that point, this total stock would be fixed forevermore, right? And I've read some places where the argument is made that this doesn't present a problem for Bitcoin because Bitcoins can be almost infinitesimally divided, which is fun. Like you have a billionth of a Bitcoin. So if you have more goods to trade in Bitcoin against, you can always make smaller prices. That's fine. Sure, that you want that, right? But there's a production problem involved here that I want to go through. There's another problem of production that's involved. If you have a money that just is totally fixed in supply, as you can imagine, no such money like this would ever exist normally on a market. Again, Bitcoin is kind of an artifice, right, that we create as a money. But a regular sort of money, that like historical monies like gold coins or silver coins, privately produced historical money, was never fixed in supply. There's a good reason for this. And so that's what we want to examine. What would happen once we reach this maximum and the stock never goes up again? Well, the problem has to do with price deflation and interest rates. If we have economic progress and the amount of goods we're producing every year is going up and up and up, and we have a fixed money stock, then the prices of the goods have to fall, right? And we've had periods in economic history where the increased amount of money produced each year has not kept up with the increased production of goods, and we've had gentle price deflation. In fact, the period of greatest economic growth in American history was the 1880s.
Growth rates were faster in the 1880s than any other decade in American history. And we had gentle price deflation, about 1 to 2% price deflation per year in that decade, because output increases were more rapid than the increased production of money. But what would happen if you had a fixed money? What if you didn't have any increase in the money stock, and you had, say, 5% or 6% increases in the production of goods? Well, you could have 5 or 6% price deflation. Now, if you had 5 or 6% price deflation and the going rate of interest were 3%, I should say it was determined that way by the intertemporal preferences that people had. They were willing to lend and borrow at 3%, then you could see this is a big problem, right? People will not lend if they want a 3% return and the money appreciates by 6%. They will not lend to people at a negative 3% rate of interest. This is because they can just hold on to the money and get 6%. So why lend and get a negative interest rate? People won't do this, right? Which means that Bitcoin could never be used for credit transactions. And credit transactions are huge. You'd have to have another money to go alongside Bitcoins if Bitcoin ever became money, or any money that had, even if it were gold, that would be true. If you had a fixed supply of it, and people had, as we say in economics, time preferences that were low enough so that interest rates were below the appreciation rate of the money, then that particular thing would never be used for money in financial markets. People they would just, again, given a choice, they would just hold it back, right? Hold on to it as opposed to lending it at negative interest rates. So it wouldn't function as money in a sort of complete normal sense. This is a big problem, by the way. This is an economic, analytical problem with any money that would be in fixed supply. Money production, to the contrary, on the market is always, as we say in economics, economized. The production is always efficient. It's always integrated into the profit and loss calculations. So in a private economy, if we had, let's say back in the 19th century, if we had private gold production, then the mining and minting companies would just do regular profit calculations to decide how much to produce. And if money was appreciating, then they would ramp up production. Just like if the price of your output were increasing in any production process, that would give you more profit, and you try to ramp up production. As you try to ramp up production, well, then your costs rise, and eventually this equilibrates again, right? This production of money is resources are drawn into it efficiently. And remember, with gold, this becomes more malleable than just annual production coming out of the ground, right? Because if the monetary value of gold went up, and the value of gold in jewelry and dental work and so on stayed the same, that gold could be drawn into money too. And therefore you would have a sufficiently flexible money supply, so to speak. You'd have a money supply that responds to the scarcities of things in the economy. And in fact, that's the great advantage of having a private money, as opposed to government fiat money. Government paper money isn't subject to the profit and loss test when it's produced. And therefore, it can just be overproduced, right? And politicians are not reticent about producing a lot of money, since they're the ones that get to spend the money. So we always get inflation then, right? We always get more inflation than we get in the market. So this is an economic problem, really, with Bitcoin. I just threw this up, put these data together about gold production just to show you what this is like. Because a lot of people, again, think that the gold stock is fixed. It's not fixed. These are annual production in metric tons of gold. I just picked out these years to spread them out over the 20th century. But you can see that when gold prices go up, production goes way up, right? So we know from 2000, gold prices started to soar, and production ramps way up. It's not that hard to produce, significant amounts of gold, and more is being produced annually on average over time. So it's just the opposite of Bitcoin, right? Where less and less is being produced annually over time. And again, that's not incidental. That actually has economic consequences for choosing something as a money. Now let me just quickly run through a few other points about how Bitcoin is functioning. And most of you know that it started really as the blockchain is a peer-to-peer transfer system of funds. It doesn't have to be Bitcoin. Presumably, you can transfer funds in any currency that you wanted to, as long as you had this blockchain intact, right? So you could tell each step of the transfer, where the money, who's holding the money, who's holding the funds in the currency. And the idea behind the peer-to-peer transfer of funds was to cut out the middleman. So this is a typical kind of financial innovation. There's nothing unusual about this with respect to Bitcoin. There are lots of financial innovations in history that have allowed the customer, you and I, just regular people, to cut out the middleman and to avoid middleman fees, right? We typically absorb these fees because the middleman performs a function for us. Like banks, for example, will absorb the function of making sure that when we write a check, the funds actually get transferred to the merchant where we're buying the goods. We rely on the bank to make sure that the funds are transferred, right? And the bank, so we're willing to pay a fee to have that done. But with Bitcoin, we can cut out with some kind of a secure peer-to-peer digital transfer, we could cut out the middleman. This is why, by the way, the institutions that are most interested in Bitcoin right now are Goldman Sachs and JP Morgan. You may have seen the stories. Again, I watch economic news, so I don't see the tech stories on Bitcoin. I see the economic stories. Goldman Sachs is interested in Bitcoin. Why? Because they want to have a peer-to-peer system of transferring funds for Goldman Sachs to use internally. But you can see that this would be a radical change if people could use it generally, because then they could cut out Goldman Sachs to the extent that Goldman is doing this kind of middleman function. That's not their main business. But commercial banks tend to do this middleman function. This function could be cut out. So Bitcoin could have a big future. Or some similar process like Bitcoin. But it's probably going to be, if it does have a future, it's probably going to be in this kind of peer-to-peer transfer of funding. This they call it no trust. You don't have a middleman to verify that the transfers occur, because the Bitcoin protocol does this automatically, or at least we think it always does it automatically. Been some suspected cases, I guess. Anyway, you may know this. So it starts peer-to-peer, and then it was used mainly at first for these peer-to-peer transfers to charities. So charities started to advertise, hey, donate Bitcoin. Like they did with used cars or whatever they'd say. Donate to us in Bitcoins. And this is just a marketing technique they use. And so they got a little traction with this, and people started to use Bitcoins for charities. And then it started to become an investment asset. One of the puzzling things to an economist about Bitcoin, Bitcoin is supposed to be a peer-to-peer transfer system. That's every time you read about Bitcoin, that's what they say. It's invented as a peer-to-peer transfer, so that we can cut out the middleman and do this directly. So we don't have to use banks or we don't have to use credit cards or whatever, or debit cards. We can just directly do this outside the banking system, and that's great. And then you hear they're Bitcoin exchanges. See, that doesn't sound right. Why would somebody set up an exchange? Isn't the whole point of Bitcoin to go peer-to-peer? Why do I have to have Mt. Gox? What's that for? Why do we have Bitcoin warehouses? What are those? And the answer is, the people who were pushing Bitcoin as an investment were trying to normalize it. We're trying to get more people to invest in it by normalizing it, making an exchange where you would buy and sell Bitcoins, you buy and sell stock. So it's totally foreign, it seems to me, to the whole Bitcoin principle, which is you want direct peer-to-peer trade. You don't need exchanges for it. That's what you're cutting out. You're cutting out the exchange when you have peer-to-peer trade. It would be like trading a General Motors stock directly to another trader, and not through a broker at the New York Stock Exchange. That's what you want to do, is trade directly with people. So that always I thought was a little bit odd, right? And this is where we get all the exchanges, we get the Mt. Gox and all the problems that occurred with them. They were holding bitcoins. What are they doing? Why are they holding bitcoins? Why are they, right? It just all seemed weird. But what they were doing, I think, was trying to provide a kind of standard treatment of bitcoins as an investment vehicle. And that's when the bitcoins take off, right? The price that we pointed out before, the price goes skyrocketing, and then Mt. Gox has some trouble and crashes. That's typical of an investment, kind of a new investment market. So I think that will probably all go away, because that's not really what Bitcoin is designed to do. So I don't think you'll see it as an investment vehicle long term, or a money long term. I think you'll see it again as a peer-to-peer transfer system. That's what it's designed to be. I think that it has value this way. There is some demand for it as a means of payment. I read the funny story about how the very first Bitcoin transaction was it 10,000 Bitcoin for one pizza? And there's the very first, normal commercial transaction, 10,000 Bitcoin. Today would be a pretty high quality pizza. But back then a Bitcoin was whatever, 8 cents or whatever, when this first started. So there, merchants started to take it, and again, this is kind of a marketing thing, right? So, hey, we're hip and we're cool. We'll take your Bitcoins. Come and spend your Bitcoins here, that kind of thing, and that's fine. There's nothing wrong with it. The strategy. I just don't think that somehow is the first step toward making it a general channel. So that's why I put this last part on here, the money of the future. So let's think about first some questions about, in the abstract, about Bitcoin in competition against other potential monies. We already mentioned one drawback of Bitcoin. But Bitcoin has advantages, no doubt, as well as in currency competition. But the one big drawback it hasn't mentioned before is that at some point you can't produce anymore. And as long as we continue economic progress, which hopefully we will, that Bitcoin will not be a suitable money for credit transactions. And therefore, at best, it would have to be supplemented. You'd have to have two monies, one for normal, present cash transactions, that would be Bitcoin, and then an entirely different money for credit transactions. And again, people probably wouldn't choose this, right? They would probably just go with the standard money. One thing is money, because one thing is money is always preferable in doing accounts. Imagine how difficult it would be to run your business if you were using two currencies. Right? It's hard enough in the real world where you have different foreign currencies, right? You're a multinational company doing this. But with Bitcoin being used for all your present transactions, and then the U.S. dollar or something like gold or whatever being used for all your credit transactions, you can have this difficulty, right, in telling exactly how accurately are you assessing the value of things, since you're doing it in two different monies. This becomes problematic. And my point is simply it probably then wouldn't be chosen as a money. There are other suitable items that could be chosen in this abstract sense, that people were just free to choose whatever they wanted to use as money. We could use gold coins or silver coins, some historical money, some cryptocurrency that did allow for increased production over time. Would probably outcompete something like Bitcoin just because of this problem. So I think in currency competition, there would be some serious disadvantages to Bitcoin, not the least of which is this problem, this production problem. Now I wanted to mention one other thing that kind of plays off of this. Because of this problem of accounting in different monies, there's always a tendency for people just to choose one thing as money if they're free to choose. Just a single thing, so they can have uniform accounting. This just simplifies and makes more accurate all of their business decisions if they can do this. So again, if there's one thing that could be used as money uniformly, that would tend to have a big advantage over Bitcoin. That I think can't be used for credit transactions once it hits its production maximum. So again, I don't think it would outcompete other alternatives that were offered by private businesses in a competing currency setting. Now, the other thing I want to mention is about state intervention. What about that? I mean, here we are in the real world. Can Bitcoin ever get started in the real world? And here I think that you probably, if you're keeping up with the news, you know that the news has not been good for Bitcoin. It looks worse and worse. The regulatory process looks worse and worse for Bitcoin the further we go along. And I just want to mention one of these. This hit the news just last week, I think. It's the IRS. So there have been a couple of lower courts, a couple of courts in Texas, for example, that have declared for purposes of contract disputes that Bitcoin was in fact a currency. But the IRS begs to differ. And frankly, the IRS is more important than what the Texas district court says. The IRS says Bitcoin is property. They've declared this now. This is their official position. They put this out, I think, on the 25th. What this means is, just like gold coins, you have to pay capital gains tax on Bitcoins. This is precisely the reason why people don't use gold coins as money. Can you imagine? The IRS used this example in their statement. If you buy a Bitcoin for $1, and then 2 months later you go and you buy a cup of coffee for $2, you owe capital gains on $1. Every time you make a transaction, you spend that Bitcoin to sell it, then you owe the capital gains tax on the difference between the value of what it was when you bought it and the value of what it was when you sold it. Now, you can write off losses if the price goes down, just like the losses could be written off. But the point is, this is a huge burden to anybody that uses this as a medium of exchange. Can you imagine the difficulty if you had to do this for US dollars, can you imagine the difficulty just in tracking all of this? Just keeping track of when you got that particular dollar and then when you spent it, what it was worth. Now, this would just be an insufferable burden, right? Which is, again, as I mentioned, was precisely why people don't use gold or silver as money. Because the IRS treats this as property. And every exchange of it then is taxable as a capital gain. And so people throw up their hands and say, well, okay, well, I'm not going to be spending gold every day, right, or silver every day. And only if the government were to withdraw all these legal impediments could any of these private options become money. They're suppressed by the huge array of government legal impositions on their use. Not the least of which is this, right? Just so everybody was clear, they also pointed out that miners are going to have to pay income tax on the bitcoins they mine, and the income assessed will be determined by the price of bitcoins on the day that they receive, get the coins through the mining process. The IRS even said that all these taxes are owed retroactively. You can petition the IRS to avoid them on some reasonable grounds. You can say, well, there's a good reason that I can't pay this tax, I don't know what it is or whatever. And they may let you off the hook. But technically, they said these are all retroactively owed. So this is not good, right, for the fostering of the use of Bitcoin socially. It's not going to help. So the buyers pay capital gains on the tax. The sellers also pay so the coffee shop that gets the two Bitcoins when you pay the coffee or whatever it would be, 1,000 for the Bitcoin or whatever, they then just pay tax on that as regular income, just like they would with USD. So that's no different, right? They're just saying, look, we're going to treat this just like a commodity trade. If you were doing the same thing and taking a value, you have to pay taxes on things that when you barter too, technically. So again, can people avoid the tax with Bitcoin? I don't know. It's again one of the advantages of Bitcoin is that it tracks the movement at every step, right? And it may be that people can be anonymous in the tracking, but tell that guy from Silk Road, it's not clear that you're anonymous. But in any case, that every step is tracked. So certainly the government has access to the blockchain, and they can see step by step how the Bitcoins have been transferred. And then it's just a matter of identifying people. So again, the anonymity is probably not as great as some have made it out to be. Okay, so I saw a question.
It was about the anonymous. I was going to ask how they were going to find people if the Bitcoin, the peer-to-peer thing is with that your wallet code is all anonymous. How are they going to track you down and get you down?
Yeah, I think it might be the case that there could be a dedicated small group of people who use Bitcoins anonymously. Maybe that could happen. Again, I'm not sure what the government could do about that. I'm just not tech savvy enough to know how they break whatever anonymity principles people could set up. But the problem with making all of this normalized is that the average Joe isn't going to do this. I'm sorry, the average Joe six-pack, he's not going to do this. We're kidding ourselves if we think that the average person is going to take the risk. Tech savvy guys, okay, but I'm not going to take the risk, and most people won't. Right? So the point simply is that we have a system, this vast system of government intervention that suppresses all attempts for private competition. The government doesn't want private competition to its money. They want to stamp this out, and they'll actively stamp it out, just like they have with gold and silver. So it's no different with Bitcoin. They see Bitcoin as a viable private alternative, and this is the sort of thing they'll do to it. And once they do this, well, it's unlikely then that the general population will sort of ignore this and break through this.
You're listening to the YMB and BTC podcast. We need your help. First of all, we'd love it if you could check out our website, YMBandBTC.com. There you can find donation addresses for every single article and episode, and we'd love it if you could make use of those. We could also use some fans and followers, so if you're willing, please visit Facebook or Twitter.com/YMBandBTC. Lastly, remember to subscribe to the show. You can do that on iTunes or sign up on our website to receive email updates. Thanks for your support.
So anyway, at this point I'll stop and I'll go ahead and take other questions.
This might be an impossible question to answer, really, but given how our current currency is, and how it is a fiat currency, it's not really based on anything technically. Could Bitcoin, had these things not happened, been a competitor to something like that? I don't know if that's even possible.
I think so, but I think it would have to deal with this production problem.
Yeah.
I think it would have to deal with the production problem. It would have to also demonstrate to people that it had some sort of benefit over historical private funds. And maybe it does. If it can overcome some of the inherent problem, like this production problem, perhaps it could. Because as you say, it isn't necessary for something to be tangible, to have sort of, sometimes we call this intrinsic value, right? To have commodity value. It isn't necessary for something to have commodity value to be money, or fiat money proves this. And so privately, something like this might be possible to introduce something like this. It isn't against any economic law that you could introduce something like this, but it would have in a competition currency between different monies, or possible money, it would have to be better than the historical commodity monies. People would have to see it as preferable for some reason. Again, the governments can always suppress it through law, and then defend their own or give their own fiat money legal protection. They pass legal tender laws and so on. Require people to use it under penalty of law. But if we had free market currency competition, then these different options would have to stand on their own merits. Right? And so Bitcoin maybe would have to be redesigned somewhat to outcompete the other viable options. cost.
So it's your opinion then that Bitcoin would face no problem against Mises' regression theorem?
No, I don't think that's kind of a technical question, an economic technical question. So yeah, I'm glad that came up kind of at the end. The regression theorem, for those who aren't econ geeks, the regression theorem is a theorem about the origin of money, or it's bound up in precisely this question of how can new monies arise? How can new monies be introduced? And the way in which money became introduced originally in society was that is a scenario, it's kind of a thought experiment that economists do, that if there were a barter economy, then in this barter economy, there would have been, some people would have had trouble of making their barter trades. And they would have, just in entrepreneurial innovation, they would have hit upon the idea of making indirect trades, of trading their good for something more tradable, and then using the more tradable good to buy what they wanted. And as soon as they did this, then you would have imitation. You get something like a network effect. And other people imitate, right? And as they begin to imitate, it makes this good that's chosen even more marketable and even more suited to be a medium of exchange. And so it's pretty easy to see the logic of how this would happen. And then we can just see how money might progress from primitive commodities to more sophisticated commodities, to coinage, which certifies the commodity, and modern innovations and so on. So the regression theorem has to do with this particular kind of question. When you introduce a new money, does it have to somehow have its value tied to an existing money, or can it sort of bubble up naturally, just out of trade, like the first money did? So a new money could be introduced in those two ways, presumably, right? Like, for example, the money we use, Federal Reserve notes, our paper bills, they were first printed in 1914. And so when they were first printed up, why did people accept them as money? Why didn't they just continue to use the Treasury certificate? And the answer to this question is the government promised to redeem the Federal Reserve notes at par on demand for Treasury certificates. They said, look, we stand ready whenever you want. You just come bring us those Federal Reserve notes, and we'll give you the equivalent Treasury certificates. So redemption claims are necessary, or one way to introduce a new money. The euro was introduced this way in Europe, and so because it has to meet this principle of economic law that the regression theorem is referring to, that a money must have market value to be accepted as money. If it doesn't have trade value, exchange value against things, then it can't be accepted. And so this question was raised right at the beginning about Bitcoin. Does Bitcoin have sufficient trade value, exchange value against other goods to even become money? Or does it just sort of peter out at the very beginning, right? And I think the answer to this is, I said before, there are really two ways that a new money can start up. It can start up as a redemption claim to an existing money, which is the usual historical way that this happens. Or it can just start on its own. There's no reason it just can't start on its own. So I don't think this issue speaks against Bitcoin. I don't think the fact that Bitcoin would have to start with widely traded value is a necessary principle for a new money to start up. A new money can start from anything. But it has to start, it has to be something and then be traded among people. And then people have to see, oh, that's even a better way to trade. That's a better currency to trade with than the alternative I'm using. Because after all, in some places in history, people started trading with cocoa beans. And then they came in contact with other people who traded with gold, and they gave up their cocoa beans. And so gold in that market didn't start out probably as a redemption claim for cocoa beans. It probably started just in trade. And so Bitcoin could start this way. I don't see that that's a barrier.
I guess it'd be interesting to get your comment on when I'm trying to explain, like with friends, what Bitcoin is and like discuss kind of what it is. Right? Kind of think of it as that it's like sort of a money of zero maturity, in that it's you can hold it and break it down indefinitely, but it is very volatile. But it's it's very easily converted into dollars, or if in the world market whatever the prevailing currency is in that area. So do you think that has any validity? I don't know.
I think that treats money. I think there's a somewhat unnatural way of treating Bitcoin, because in my judgment, Bitcoin, fundamentally, the function of Bitcoin is to make these peer-to-peer transfers, and therefore it's not really an investment vehicle. To be liquid, the only way to make Bitcoin trading liquid is through exchanges. To do it quickly,
Right.
That's why you get the existence of these exchanges, because they want the investors in Bitcoin to be able to know that they can sell them at any time. You have a deep liquid market, and you can just come and sell. So go ahead and invest. Don't worry about finding another buyer. We'll negotiate that. We'll be the middleman for you. We'll make sure we find buyers when you're ready to sell. So I think that whole thing is kind of is an artificial element. It's been added to Bitcoin. I don't think even if Bitcoin does become money, it necessarily has to go through this process to become a liquid asset first, and then money. There are lots of liquid assets that never become money. And there are lots of things that become money that were never liquid assets before. So almost all commodities are priced this way. But commodity monies, they're not particularly, they're widely savable, but they're not particularly what we think of as liquid assets before they become money. They just grow into money. They grow into money by progressive use that people have. Again, it's not to say that's an easy thing. Again, you have a network effect, right, to overcome. Everybody's trading in USD. And you already have this wide market where everybody's using money, getting the benefit of using the money, the standard money. And it's sort of hard to convince people to move over to another network, right? It's a lot smaller and less developed. That's why one path towards this is, and again, how you do this in practical terms is a difficult question. Leave it to my poli-science colleagues. You have to get the government to take away the legal privileges of its own money. Because unless they do this, no private money can get off the ground. Again, you can see what they're going to do to make sure that Bitcoin doesn't get off the ground with private money. They're going to declare property, and they're going to tax it. And then no normal person, no regular Joe is going to touch it.
Yeah, I was wondering, for tax purposes, like how would the IRS determine what the value of that property was?
They would, I think they would do it just like all capital gains taxes. They would require you to have a documentation of the price when you bought it. So you would have to get a bill of sale or something when you bought the Bitcoin, and then the price when you sold it. And you would have to report this when you do capital gains. When you buy and sell a house or something and you get a capital gain, just report this on your 1040 form and pay the relevant tax. So you had self-report. Some of it would, I think, probably be self-reporting.
What about the Bitcoins that are mined?
Yeah, what they said was, now again, how they would enforce this, I don't know. But what they said was that the miners would have to value the Bitcoins that are given to them in the mining process according to the price that day. So if your computer solving your logarithm and it solves it on April 5th, and you get whatever 50 Bitcoins, then you would pay income tax on 50 times whatever the price was of Bitcoins that on April 5th.
Okay. And the price would just be like how would the government define like the relationship between dollars and Bitcoins? Would that just be like the most popular online exchange?
Yeah, that's a good question. I assume that they would consult the. I don't know. I got my data from the blockchain site, Bitcoin blockchain site. But there are other sites, they seem to conform fairly well. I don't know, again, I haven't really looked at the different exchanges and if there's a lot of price variation. But they would probably use the major exchange. They would probably declare this in some ancillary ruling or something that, we're going to use this exchange's price. But one would expect that the prices in different formal markets would conform pretty closely. So that wouldn't be too difficult for the IRS to deal with this. As far as record keeping, I think they could probably track this. But you're right, that would present some difficulty. So there's some uncertainty for the miner, some difficulty in record keeping for the traders and so on. Yes.
What about with the productivity or the production aspect of it, how it can't be at once 21 million Bitcoins are produced, there's no more? What about the divisibility of it? Because it started out only being divisible to so many decimal points, and then they redid stuff, and now it's more decimal points.
Right.
Like, what if they were to continue doing that? And that's essentially just creating more Bitcoins every time they add a decimal point to the ability of.
Yeah, but the problem is, when I make a loan, I transfer a certain number of Bitcoins. Let's say I make a loan, whatever the division of the Bitcoins happens to be on this day, I make a loan of 2 Bitcoins. And then, 2 years from today, I'm going to be paid back. But unless I'm paid back more than 2 Bitcoins, then I'm better off financially if I just hold on to my 2 Bitcoins, no matter how the Bitcoins are divided over time. It is true that you can, the existence of price deflation is not the problem. As you suggest, you could just keep dividing the Bitcoins more and more, and your wages would be in tens of Bitcoins in one decade, and then be in the single-digit Bitcoins in the next decade, and then be in tenths of a Bitcoin the next decade. But you'd have more purchasing power over time. So your wages go up and up and up, your real wages, even though your nominal wages in Bitcoins go down and down and down. So that's not a problem, as you rightly suggest. The problem is in making loans. In making loans, people just won't do this in Bitcoin. Because the Bitcoins, the people who are borrowing won't pay back the appreciated Bitcoins. They won't pay back enough to the lender to compensate the lender for the actual Bitcoins he forked over. Because their Bitcoins in the future are worth more. And it just won't, it doesn't make sense for them to pay back sufficiently so the lender gets a positive rate of interest. If the lender doesn't get a positive rate of interest, he'll just hold his Bitcoins, because then he has his Bitcoins in the future. And that's better than getting fewer Bitcoins in the future. So that problem, I think, remains no matter how you divide the Bitcoins. But you're quite right. There's no problem with price deflation in general. That's not a problem at all. And whoever designed the Bitcoins was quite correct about this. All you need is the visibility of the unit. And if you can make it, more or less indefinitely divisible, then price deflation is never a problem.
I'm not sure I completely understand that, because, your example earlier was if Bitcoin just in general is going up by 6% and interest rates are at 3%.
Right.
But, if I loan you 100 Bitcoins at 3%, then you pay me 103 back, that's going to be 3% plus the 6% in terms of just general value, because that's
right.
That's how much they're worth.
Right.
So what's wrong with that?
I'm not going to pay you that if I'm the borrower.
Isn't that what the agreement was?
Then I'm paying you a 9% return. Why should I do that?
Right, so then you could lower the interest rates, or...
Exactly. But my point is, if the price deflation rate is in excess of the actual real agreement of interest payment between people, then you would have to have negative interest rates, and you can't have that. You're right. It might not, empirically, it might not work out that way. It might work out that the price deflation was just 2% and interest rates were 5%, and you could have a net 3%, and that would be fine. I'm not saying it has to be that way. I'm just saying that's a potential problem. It's a potential problem if the price deflation is fast enough, the rate is great enough that it overwhelms the actual real exchange agreed upon by the lender and the borrower. And then it becomes a problem. That's a good point. Yes.
How would the government tax people in where there's not legal tenure, where it's just competing currencies.
Well, that's why they declare it property and they say you have to pay a capital gains tax. You have to pay it in USD.
Right.
Yeah. So that's the idea, right? It's just like I buy a gold coin, and I paid $800 for it, and then 2 years later I sell it for $1,200.
Right.
So I pay the tax on the $400.
Right.
Well, how would they, like, if there was no legal tender,
Oh, I see what you're saying.
how would they tender?
They would just declare the tax. They could use exchange rates between competing currencies, or again, if there was just one private currency. So if everything were in Bitcoin, they could just tax in Bitcoin. Right? Or if everything were in gold money, they could just tax in gold. So that wouldn't be particularly problematic. What might be problematic is if you have several currencies people are using in their taxing jurisdiction. Then they might have some difficulty in figuring out, if they were worried about sort of fairness,
Right.
they might have difficulty in figuring out, the exact exchange rates and what would be owed by different people in different monies. So that could be somewhat problematic. People might even move in and out of money depending upon the advantage it gave them in taxes. Yeah, so it's true you could have a problem like that. But remember, the tendency would be in a private competing currency system. The tendency would be for one group of people to actually adopt just one thing. So you probably see something like a worldwide gold standard, a worldwide silver standard. At least back in the 19th century, you would have seen something like this. With new innovations, we might see something else in the future. But there's always an advantage commercially from just having one name. The businessmen don't want these multiple names either. Yes?
Yeah, going back to the interest rate question again. So if Bitcoin were the dominant currency, then wouldn't the interest rates just by like market forces move like above whatever the deflation rate was, so that lenders still made money? Is like say I want to borrow money in dominant currency is Bitcoin, and the lender knows that this could be inflation, and so so I'll be willing to pay a higher rate to where like it'll be profitable for the lender above whatever he would lose from not having his money.
You can imagine scenarios under which those things will be compatible, but you can also easily imagine scenarios where they're not compatible. Right? I mean, if Bitcoins are going to appreciate 10%, and the lender and the borrower are willing to exchange at a real interest rate of 3%, then that's not going to work. There's no positive interest rate that can be charged between them that would allow the borrower to pay just 3% and allow the lender to receive 3%. Right? But you're right. There are other scenarios where it would work out. If the price deflation were modest enough, it would work out. I mentioned the case of the 1880s gold standard. We had price deflation about 1% to 2%, and that worked out fine. Empirically, that was fine. There was no disruption of financial markets at that sort of modest price deflation. But my guess is that there was significant gold production. My guess is if you really had a fixed stock currency, price deflation would be pretty extreme, and probably would be greater than the historical real interest rates, which run about historical real interest rates run about 2% or so for short term and about 4% for long. Maybe 3 and 5, something like that. So that that's probably right in the range of the kind of price deflation you might have under Bitcoin.
Now we can take one more question.
Sure.
Do you see a fundamental problem in sort of the people who first started mining Bitcoins, and that there's these sort of Bitcoin billionaires who have this huge stock of Bitcoins? Do you see that as possibly a preventative measure to it ever becoming, or something like that, becoming a medium of exchange? For example, if there was someone who owned 80% of the gold stock, just from the outset, could that be a preventative measure for something becoming a medium of exchange, because I could just flood the market and just completely disrupt the entire financial market? Do you think something like that could occur?
You mean like the Federal Reserve?
Yes. Yeah.
No, it could be. Yeah, it could be that people. It does depend on, the viability of the money does depend on people's expectations about it, right? And so, They could just give up something that was perfectly suitable, its properties were perfectly suitable to use it, precisely because they feared this kind of manipulation. There's no doubt something like this could happen. It's likely, of course, what people would do is select. That would be one of the properties that they would use in selecting money. They would shy away from monies that somebody had 80% control of the stock. Precisely, because you're right, that could be a potential problem.
Maybe that way.
Thanks for listening to episode 15. Tune in next Thursday.